Setting yourself up for success on the road to zero, the path you'll take to pay your student loans down to zero, will take strategy and planning. Creating a successful strategy will require an awareness of your financial goals, short and long-term career goals, short and long-term personal and family goals, and an acknowledgement of your current financial situation. Access Lex Institute is a nonprofit organization committed to helping talented, purpose-driven students find their path from aspiring lawyer to fulfilled professional. In partnership with our nearly 200 member law schools, improving access and positively influencing legal education have been at the heart of our organization's mission since 1983. We are a nonprofit, and everything we do is free to you. As you embark on your loan repayment journey, one of the most important things to remember is that you have choices. Depending on how you count them, we now have around 9 federal student loan repayment plans. The good news about this is that you have lots of choices, and one of those plans will work well for you right after you graduate. You will also have a plan that will work well for you 3 years down the road, 5 years down the road, 10 years down the road, and more. That plan may be the same as it was right after graduation, or it may be different. You're able to change plans throughout your repayment, and it'll be a great idea to reevaluate your current financial situation periodically to make sure you're still in the plan that's the best fit for you. Some of the things we discussed at the beginning of this presentation, like your current financial situation, your personal goals, financial goals, family goals, and more, will play a role in your personal decision on the best loan repayment plan for you. When you're ready to pick your student loan repayment strategy, the very first thing that you'll want to do is to make sure that you have the most up-to-date, accurate, and pertinent information, and that's something that we'll be going through in this session together today. The next thing you'll want to do is to be sure that you're making the decision that's best for you, and we'll give you the strategic tools you need to do that. And then finally, you want to be sure that you're revisiting that decision periodically to make sure that it's still the best decision for you as things change throughout your life and your career. And again, we'll be giving you some tips and tricks for revisiting and making those subsequent decisions. Where do we get started? Well, the very first thing that you'll want to do is to collect all of your loan information. For federal student loans, which are what most students are using to pay for graduate and professional school these days, you can find all of those listed on the National Student Loan Data System. nslds.ed.gov is the website. There are the occasional unusual types of federal student loans that may not be found there, for example, something like health professions loans, but outside of that, all federal student loans should be listed on NSLDS, and it's a great place to start. The next source that we recommend is annualcreditreport.com. The reason we recommend that is it would show you any private loans you may have borrowed for current or prior degree programs. It's also a great thing to pull and check annually if you haven't done that already for a few reasons, but the main one is as a law student, they will pull a copy of your credit report as part of the character and fitness portion of the bar. So if you're getting ready to graduate, now would be a great time to take a look at that credit report and make sure everything that's on it is accurate, up to date, and belongs to you. But again, it will also be a great resource for finding any private student loans you may have borrowed. The final piece of this puzzle may be any other debt obligations that you have, whether that's credit card debt, a car loan, understanding with a parent about helping a parent to repay Parent Plus loans or prior borrowing, that kind of thing. All of those pieces of information will color your overall financial situation and will absolutely have an impact on your decision about the federal student loan repayment plan that's best for you. As you're using the resources we just mentioned to collect information on your loans, what are some of the pieces of information that you're looking to collect? Well, the usual suspects, of course. You'd like to know the type of loan, the balance, the interest, all of that type of information. But in addition, some federal student loan specific types of information you'll want to collect include things like your grace period. The grace period is the window of time after you leave school before payments are due. That's typically about 6 months for federal student loans, so if you graduate in May, your first payments will be due in November or so. However, if you have loans from a prior degree program and you took off more than 6 months between that prior degree program, like your undergraduate degree, and the current graduate and professional degree you're finishing up, you do not get that grace period back. So let's say you finished your undergraduate degree, you took 5 years or so to work and travel, and then came back to graduate school. Those loans from your undergraduate degree will go into repayment right away after graduation, so you'll typically have a payment due within about a month of graduation. However, loans from your current degree program do still have their 6-month grace period, so those will not have a payment due until November or so. So again, that's something you want to check for very carefully, especially if you took off time during a current degree program or between degree programs, to make sure you know which loans have grace periods, which ones don't, so that we can make arrangements for any loans that will have payments due very, very shortly. The other big piece of information that's important to collect at this point in time is the servicer. Servicer is an organization that contracts with the federal government to handle the day-to-day processing of your federal student loans. They're the folks that you'll talk to about making your monthly payments, about changing loan repayment plans, any of those kinds of procedural operations. They are there to handle any questions that you have and implement any changes you request. So it's important to understand who your servicer is, to take a few minutes and make sure your servicer is the same for all of your loans. Especially if you have a Perkins loan, you want to pay particular attention to the servicer on those, but just taking a few minutes to go through and double check the servicer on each of your loans to make sure you have the same servicer for everything can save you some substantial headache down the road in the off chance that you have multiple servicers. As you're going through the National Student Loan Data System, or nslds.ed.gov, you'll see a list of your loans similar to this. This is the area where you'll want to be looking for information on your grace period, on your servicer. And I will make one quick note: as you're going through NSLDS, you'll see all of your loans listed. Each of your loans has a number next to it in a little blue box, and that little blue box is a link that will take you into a detail page on your federal student loan. So keep an eye out for that and click through each of those just to get organized before we get started. Once you have all of your information pulled together, the next step is to know more about the federal student loan repayment plan options. I mentioned at the beginning of this session that there are a whole bunch of those. We're now up to 9 or so. But what we can do to make them a little easier to process is to group them into similar categories. The first main category are those that are debt-driven, and these are the kinds of repayment plans when you think about borrowing and repaying larger sums of money, like car loans and mortgages, where the lender is taking a look at how much you've borrowed, the interest rate on that debt, how long you have to repay it. They're running a calculation for you, and they're giving you the amount that you need to pay every month to pay those loans off in full in the time allowed. Pretty typical stuff about what you'd expect, and there are several federal student loan plans that fall under that umbrella. The next category, though, are a little bit different, and these are newer, at least to the world of federal student loan repayment, and these are the income-driven repayment plans. Overall, the way these work is to take a look at how much money you're making every year, typically from your tax return. They set aside a little bit of money. Whatever's left over is what they use to determine how much they think you can afford to pay every month towards your federal student loans. So you'll notice there are a few things that didn't fall into that conversation anywhere. We didn't talk about how much you owe, paying it off, anything like that. The income-driven plans are really based entirely on your household income, and we'll talk more about all of these plans here in a minute. First, let's drill down into the debt-driven plans. The standard plan is the default plan. If you don't take any action by requesting another plan through your servicer, you will be put into the standard plan. The standard plan is a 10-year plan, which means you would make 120 equal monthly payments to pay the loan off in full within 10 years. For many of the graduate and professional students that we work with, the standard plan, the monthly payment, is very expensive if you're borrowing a typical graduate and professional level debt load. So I encourage you to take a look at that, but don't go into too much sticker shock if the initial price is too high, because of course we do have lots of other plans to choose from, and one of those may well be a better fit for you, depending on your debt level and your income. Graduated repayment is also a 10-year plan, but instead of 10 years of equal monthly payments, the payments start out in years 1 and 2, typically as interest only, so those payments are quite a bit lower. but then in years 3 and 4, the payment steps up a little bit, it steps up again until you get out to year 10 when you'll be paying the loan in full. A few things to know about this plan are that because you are backloading more of the principal, you will pay more in interest overall when you talk about your total out-of-pocket costs with this plan. And then again, another important piece is that with typical graduate and professional level borrowing, sometimes even the interest-only payments at the beginning of years 1 and 2 can be a little steep depending on your debt and your income. If you're considering one of these plans, the idea behind it, of course, is that over time your career will take off, your salary will grow, and these payments will become more manageable. But I do encourage you to take a look at the full projected plan for all of the payments out through years 9 and 10 to make sure you know how much those eventual payments will be and to make sure that you expect to be comfortable handling those as well, because they can rise rather dramatically. The final series of repayment plans under this category are the extended repayment plans, where what we're doing is taking the last two that we just talked about, equal payments over time and graduated payments over time, and taking them from 10 years out to 25 years. So instead of 120 payments, we're now talking 300 payments. As you can imagine, because we're stretching everything out over substantially more time, those monthly payments drop quite a bit. But again, with graduate and professional level debt, you may find these affordable or you may not. One of the nice things about the extended plans, though, and about federal student loans in general, is that there are no penalties for prepayment. So should you find the extended plan to be affordable right out of school, please do know that you do not need to take the full 25 years to repay it. You are perfectly able to start paying more at any time, maybe when you get bonuses or holiday money, any windfalls, and then as your career takes off, you can put more and more money towards your loans every month until they're paid in full in a time that's a better fit for you and your financial situation. So these can work as a nice hybrid option for some graduate or professional students if your debt level and your income level support this choice. So I do encourage you to take a look at that one if your eventual goal is to pay your loans in full. The income-driven repayment plans come in several different flavors. You can change in between these plans as you're in repayment, but from a strategic perspective, the best course of action is to do some research, choose the plan that's best for you initially, and then try to limit the number of changes you do over time, because sometimes changing plans can drive up your total overall costs. But again, the plans are there and available for you, and it will make strategic sense perhaps to make a few plan changes throughout your course in repaying your student loans. Rather than going into all of the nitty-gritty details on each and every one of these individual repayment plans, what I'd like to do first is to talk about some of the commonalities. The first question we always get when we talk about these loan programs is how the monthly payment is calculated. Please know that you'll never need to know this. This is something that multiple calculators online will do for you, including the one on our website, accesslex.org/calculator, so you can estimate that way. Your servicer will give you your exact monthly payment after they run through the calculation for you. But again, folks do like to know where these numbers come from, so I'm going to go ahead and step through that here just as an informational piece for you. Typically, the first thing that happens is they take a look at the adjusted gross income from your last filed tax return, last year's tax return. From that adjusted gross income, or AGI, they set aside a portion of your income as untouchable. That portion is based on the federal poverty guidelines for a family of your size in the state where you live. For the current year, that's around $12,000. So, and that's in the contiguous 48 states for a family size of 1, and they take 150% of that, so call it $18,000, and they set that aside as untouchable. Whatever's left over, that darker orange bar in our graph here, is considered to be your discretionary income, and from that they take a percentage, 10, 15, or 20%, depending on the plan that you choose. That's what they say you can afford to pay for the year. Divide it by 12 for your monthly payment, and then you get what you'll owe every month under one of these income-driven repayment plans. Again, I promise you'll never need to know that, but some folks like to know where the number comes from, so it's good to go through. We have a resource on our website called the Road to Zero booklet, which will go through each of these individual plans. It's a great companion piece for the conversation we're having together today. The middle page of that booklet goes through each of these individual repayment plans in great detail and talks about the things that you'll need to know in choosing between these plans. I'd like to go through a few of the pieces of information on this current screen together, and again, I do encourage you to take a look at that booklet. I do think it is a very helpful resource. You'll see that middle column with red text talks about the percentage of discretionary income that they would be using under one of these plans. As you can see, income contingent is 20%. It ends up being one of the more expensive plans. Typically, it's not something that current students are really looking at, so we're not going to spend a lot of time on that one. There is an older income-based repayment that's about 15%, but then the others are the newer plans, and they are 10% plans. So for the most part, recent graduates are looking at one of these 10% plans and trying to figure out the one that's the best fit for them. The column immediately to the left of that, eligible borrowers, talks about who is eligible for each of these plans and when you can have borrowed federal student loans in order to qualify for those. So I encourage you to review those, especially if you took some time off between degree programs or have some older loans. You may not be eligible for all of those 10% plans. Something else that you'll want to pay attention to as you're going through that National Student Loan Data System resource we mentioned at the beginning of this session are the types of loans that you have. Most recent loans from 2010 onwards or so through the federal government are considered federal direct loans. Federal direct loans come in lots of different flavors. There are unsubsidized loans, grad plus loans, subsidized loans for undergraduate, that kind of thing. Before 2010, there were other federal student loans under a different program. They were still called things like subsidized, unsubsidized, and grad plus, but they were under something called the FFEL loan program. So keep an eye out for that. If you see any loans labeled FFEL, if you know you went to school before 2010 or so and borrowed at that point, you'll want to keep an eye out for those because those FFEL loans are not eligible for some of the plans on this list. Another piece of information I want to call your attention to is how they handle income from your spouse if you're married. So if you look at the column all the way on the right, it talks about tax returns. In the prior step, remember I mentioned that they typically start with your tax return and they're looking at your adjusted gross income. If you are married and you file your taxes jointly, they will take a look at both incomes when determining how much you owe under one of these plans. If you are married and you file your taxes separately, for the first 4 plans on this list, they will look at the amount of income that you have on your tax return. So just your income to determine how much is owed every month on one of these plans. For the final plan on this list, the newest one called Revised Pay As You Earn or Repay, you'll see that even if you file your taxes separately, they are still taking a look at both incomes to determine how much you owe. So depending on your marital status, either current or planned, that is absolutely something that you would want to take into consideration when choosing among these plans. The final piece on this page talks about forgivenesses, which we'll talk about in a little bit. Just want you to keep an eye on the fact that there are different lengths of forgivenesses, 20 or 25 years, depending on the plan that you're in and your status as a borrower, whether you borrowed for undergrad only or graduate school as well. So please keep an eye out on that. If you choose to enter one of these plans, they will rerun that calculation that I mentioned every year. In order to do that, they need a copy of your up-to-date financial information. So there is some paperwork that you will need to do to communicate with your servicer on this and to provide them with either a tax transcript or access to your IRS data retrieval in order to redo this calculation. The Department of Education tells us that less than half of the borrowers in one of these plans remember to renew their paperwork every year. That can have decently substantial financial implications for you as a graduate and professional level borrower because graduate and professional level borrowers have higher debt loads. So some of the things that can happen if you fail to recertify are that a bunch of unpaid interest can capitalize, driving up your overall costs. If you're working towards something like public service loan forgiveness, forgetting to recertify can put you off track for that temporarily. So those are all outcomes we'd like to avoid. In some cases, you'll be bumped into a much more expensive monthly payment plan if you fail to recertify. So it's really just a great idea to treat your annual renewal date for one of these plans on the same short list where you list things like Mother's Day, your significant other's birthday, that kind of stuff, and really make sure that you're getting that paperwork in early to renew one of these plans every single year. When you're in one of these plans, the monthly payment that you're making has absolutely nothing to do with how much you've borrowed, how much interest is accruing, and so forth. It's based purely on your income. So as you can imagine, if your income is very low, your payment will be very low. That doesn't stop interest from accruing, however. So in this example, we have someone who's in one of these income-driven repayment plans. They've done all of their paperwork and their monthly payment is $125 a month. However, they're accruing $325 a month worth of interest. That extra $200 a month that's accruing and not getting paid adds up. It sort of sits off to one side in its own bucket of interest. But eventually there are some things that can cause it to be added to the balance. And if your final goal is to pay your loans in full, as opposed to working towards one of their forgivenesses, it's important to know how much interest is accruing and know what your eventual plan is for it, rather than letting it accrue and forgetting all about it. So please do know that these plans allow for that negative amortization, interest accruing but not being paid, and know what your exit strategy is for handling it. Some of the income-driven repayment plans do have interest subsidies, and that may be part of your strategy for handling that unpaid interest. So it's something to keep in mind as well. Speaking of forgivenesses, let's talk about how these work. The forgivenesses that we're talking about now have to do with the income-driven repayment plans that you've chosen. They are not tied to what you do for a living, for example, public interest work, or even whether you work at all. They're just based on time spent in the plan. The way they work is after you spend a certain amount of time, typically 20 or 25 years in a qualifying plan, any remaining loan balance is forgiven. It's important to note, however, that that is a taxable event, so please keep an eye on that and have a plan for that tax hit. But do know that that can make financial sense for many borrowers, so take a look at those and figure out how they work. For public service loan forgiveness, this one is a slightly different plan, and the way it works is it's not actually a federal student loan repayment plan at all. It's an option that you work towards using one of the income-driven repayment plans we just talked about. You need to have a handful of things in place to qualify. The first one is the right loans. Remember we talked about those FFEL loans, the older loans that are still federal loans, but a slightly different program. They don't count. The only loans that count towards this are direct federal student loans, whether they're unsubsidized, grad plus, subsidized, as long as they have the word direct, they qualify. The second step is to be in the right repayment plan, and that is an income-driven repayment plan, typically like the ones we just talked about. The third piece is to have the right job. The right job falls into one of three different categories. The first category is government, federal, state, local, tribal. It doesn't matter as long as it's a government job and you're working there full time. That's great, and they're the ones that write your paycheck as opposed to working through a contractor of some sort. The second category is a nonprofit, typically 501c3. So that's the one that's the most straightforward. You can check with your future HR department or someone at the organization to find out if they're set up as a 501c3 nonprofit, and if so, great, that counts as a qualifying job, again, as long as you're considered full-time by that employer and they're the ones writing your paycheck. The third category has a little more wiggle room to it, and those are nonprofits that are not 501c3s, where you're doing certain activities. And there are lots of resources online that talk about the different types of activities and the different types of organizations, so I encourage you to look into those. However, do know that there is some concern over some of those in terms of the clarity of who qualifies and who does not. If you've seen any recent lawsuits about folks who thought they were on track for public service loan forgiveness and were not, they may be related to this third category of employment, so just keep an eye out for those. A few additional pieces of information: you can be employed at multiple qualifying employers to meet the minimum requirements of 30 hours a week. So let's say you're working 20 hours a week for legal aid and 10 hours a week for another 501c3. Great, you put those together and that meets that minimum threshold of qualifying employment as well. So read the fine print on those, but do know that you can combine things together. And then the final piece that you need to have are 120 scheduled on-time qualifying monthly payments. Those payments do not need to be consecutive. So let's say you work for 5 years for a nonprofit. then you go for 2 years to work for a for-profit, and then you go back and work for the government for your remaining 5 years. They'll take those initial payments you made and then the subsequent payments you made despite the gap in the middle, put them together to qualify. You could take a year off to travel the world, stay home with a baby, what have you. It doesn't matter. As long as you go back to it eventually and get up to that 120, they will qualify. You can come and go. So when you have all of those things in place, after the 120 qualifying payments, you'll fill out some paperwork and then wait, and any remaining federal student loan debt that you have will be forgiven, and that is a non-taxable event. That is the Public Service Loan Forgiveness Plan that we know about at this time. We have heard some potential threats to it, some potential changes to it. None of those are, as of this time, have gained really any traction, but we don't know where the plan will go in the future. So keep your eyes peeled and your ears out, for that kind of thing. But at least for now, this is the current Public Service Loan Forgiveness Plan as we know it. As I mentioned, there is an application that you'll fill out once you've made all of those 120 qualifying payments, and we have that listed here to give you an idea of what it looks like. The other form that's available is the employer certification form, and the way that works is they recommend that you fill it out at least once a year and anytime you change jobs. So you and your employer will fill out this form to check and make sure that you are working at a qualifying employer. I would encourage you as well, as soon as you are in a qualifying job and in active repayment, so maybe around December or so, to fill out this form and go ahead and turn it in as well to make sure that your employer is a qualifying employer from the start. And then again, you'll still want to do that once a year and anytime you change jobs as well. As we wrap up the information gathering stage, there are some final thoughts that you'll want to consider for yourself to determine which plan might be best for you. Some of those will include the terms of your borrowing, when you borrowed, different loan types. As we talked about earlier, those FFEL federal loan types may not be eligible for all of the different plans. Your marital status, current or planned, may affect which of the plans make the most sense for you. Your career plan in the short and long term will definitely have an impact on your financial decision-making process. And then finally, your comfort level with debt will also play a role in which strategy is best for you. As you're wrapping up these plans and going through each one, some of the fine points, the finer details that you may want to recheck are the interest subsidies that will differentiate some of the loans, like the revised pay-as-you-earn plan and the pay-as-you-earn plan. How interest is handled, especially capitalization of unpaid interest, any limits to the maximum amount that you might need to pay each month in the form of monthly payment caps available on some of the plans, and then finally, tax implications for any of the loan forgivenesses, as we touched on earlier. For additional details on any of these plans and the details that we talked about here, please reference that booklet that we mentioned earlier in the session. The final thought and the most important thought is to make sure that as you're thinking through each of these plans, you're taking your personal finances into consideration and you're taking the time to make sure that you're choosing the plan that's best for you. Now I'd like to change gears and talk about some actual numbers. And by actual numbers, I mean an imaginary student that we've put together with some sample student loan borrowing to get an idea of how these plans might work for someone. Here we have an example student, as I mentioned, someone that we've created who's graduating from law school. This person borrowed $50,000 for each of 3 years in law school. $50,000 worth of loans times 3 years gives us around $150,000. Those loans would have accrued around $20,000 worth of interest during the 3-year in-school period and the 6-month grace period. That gives us a total of around $170,000 as this borrower heads into repayment. When we take that $170,000 and we use it in our student loan repayment estimator, it crunches some numbers for us. The first set of numbers that we get are those for the standard plans, the ones that are based on the amount borrowed, the length of time, and the interest rate. Based on those pieces of information, we know that the standard plan monthly payment would be around $1,900 a month, and the extended plan, the 25-year plan, fixed, would be around $1,100 every month for that 25-year window. To get the estimated amounts for the income-driven repayment plans, we need to estimate an income. We've given this sample borrower an adjusted gross income of around $60,000. A few key things to keep in mind here. The adjusted gross income is not the same as your salary. Your salary, of course, will be quite a bit higher, and taken out of your salary before we get to AGI are things like medical insurance premiums, contributions to retirement in most cases. Those all come out before adjusted gross income. There are lots of calculators online that will take your salary and estimate an AGI for you, so you can play around with those. The other piece of information to know, of course, is that it will take a while for your adjusted gross income to catch up to you in terms of student loan repayment. So let's say in this example, this person graduates in May and is getting ready to fill out his income-driven repayment plan paperwork in September or October. If they use the prior year's tax return, the most recently filed tax return, it may show income that's very low or as low as zero because this recent graduate was not working in the year of the tax return that would be used. So the payment could be as low as zero. And then in year 2, when the borrower goes to fill out the returning income-driven repayment paperwork to renew that plan, that paperwork using that tax return may only show 4 or 5 months worth of income because in that year, let's say the borrower began working in August or September. They won't have a full year's worth of income to show for that year. So it may not be until your 3rd year in an income-driven repayment plan that your full adjusted gross income, for lack of a better phrase, catches up with you. So keep that in mind, and it may be something that you'll want to discuss with your servicers as you apply for one of these plans. But in order to run these calculations, we made some assumptions, and one of them was an adjusted gross income of around $60,000. In addition, the calculator itself makes some additional assumptions, which include things like 4% raises every single year for the next 25 years. So no big promotions, no bonuses, but no slower years either of raises that are closer to 2 or 3%, which is closer to the national average. So you want to keep that in mind as well. We're also assuming that this person is currently single, which went into the calculator, and then the calculator assumes that they stay single with no dependents added at any time during this estimate. So again, those are some things that you may or may not be accurate for you as you go through, but we have to make some assumptions in order to make it work. So using an adjusted gross income of $60,000 gives us an estimated initial monthly payment of around $350 a month. Over time, we're giving this person 4% raises, so the calculator estimates that by year 20, the monthly payment for income-based repayment and pay-as-you-earn would rise to about $980 a month. You can see revised pay-as-you-earn has a final payment of closer to $1,300 a month, and that's based on the fact that it goes out to year 25. And of course, as the career goes on, we're assuming the salary earning potential grows more towards the end of the career by the time you're getting those 4% raises over time. The income-driven monthly payments will change every year as you file additional paperwork to show your current income or your most recent tax returns worth of income. For the purposes of these calculations, again, we're giving equal 4% raises, so you can see every year the monthly payment will go up. Over time, that will change as your income goes up. If your income goes up, the payments will go up. If your income goes down, the payment will go down, but it's important to renew that paperwork annually. Over time, what will these payments look like? Well, in the standard plan, let's say this borrower were able to afford the nearly $200 a month monthly payment, which is unlikely given the salary that we're assuming. They would end up paying about $60,000 worth of interest for a total paid of around $230,000. Clearly, there's no money left to be forgiven because the standard plan is developed in order to pay the loan in full in the time allowed. The extended plan at $1,100 a month, you can see would result in a substantial increase to the amount of interest paid, assuming the borrower took the full 25 years to pay it off in full, and the total paid is listed here on the screen. Again, there's nothing left to be forgiven. Please do remember again, though, that there are no prepayment penalties for federal student loans, so this borrower could choose extended, and then as their career started to take off, as their salary started to grow, they could pay more at any time and not take the full 25 years to pay it off, which would save them quite a bit in total paid. Under the income-driven repayment plans, we've lumped the new IBR plan and pay-as-you-earn together as they're both 10% plans. we're revisiting those monthly payments here, $350 to $980. You can see the total amount of interest paid is very close to the total amount paid, period. So it's not until the very end of the 20-year window that their income is rising enough for them to even begin contributing towards the principal borrowed. And then you can see the amount forgiven would be around $240,000. Just as a reminder, the 20-year forgiveness for IBR new and pay-as-you-earn and the 25-year forgiveness for revised pay-as-you-earn are taxable events. So on the screen, those amounts that we've listed as forgivenesses, 240 and 223, 223,000 would be taxable events. So that would show up as income in that calendar year for this borrower. So that's something that financially the borrower would want to plan ahead for and be sure that they were making arrangements for it. So at that time, they would pay whatever their tax bracket is. Let's call it maybe 25% or 30%, depending on where they are at that point. And that's something that you would want to factor in when determining how much your student loans would cost you and which plan makes the most financial sense for you. Let's talk now about some strategic considerations regarding choosing among the three 10% income-driven repayment plans: IBR new, pay-as-you-earn, or revised pay-as-you-earn. The first piece we encourage you to consider is your salary trajectory over time. One of the reasons that's important is that IBR new and pay-as-you-earn both have a payment cap of the standard payment amount at the time you enter the plan. From the last slide, we know that the estimated standard payment was around $1,900 a month. That would serve as the payment cap in either IBR new or pay-as-you-earn, so you would never pay more than that amount as long as you continued in those plans and renewed annually. In order to hit that payment cap, you'd have to have an adjusted gross income around $245,000. So for a lot of people, it would take quite a bit of time to get there. That said, it may be something that's important to you, especially if your strategy involves public service loan forgiveness. You're starting out with a very low salary, but think that it may get quite high later on. Some important pieces of information to think through as you're making your choice. A second big consideration is that revised pay-as-you-earn uses household adjusted gross income. Remember, you lose the opportunity to file your taxes separately when you're looking at the amount of your monthly payment under revised pay-as-you-earn. So that household income may play a role in your decision-making process there in choosing revised pay-as-you-earn or not. And then the interest subsidy rules. Revised pay-as-you-earn has a subsidy for unpaid interest. The way that works is, in a prior example, we said, let's say your monthly payment was $125 a month. You were accruing $325 a month worth of interest. So that would leave $200 worth of unpaid interest every month accruing on your account and not being paid. With the revised pay-as-you-earn interest subsidy, they take a look at that unpaid interest every single month, and 50% of it goes away. So in that example, the $200 a month worth of unpaid interest, $100 of it would disappear on the spot. So if you think you're looking at one of these income-driven repayment plans for the short term, but your eventual goal is to pay the loan in full, as opposed to one of those built-in forgivenesses or public service loan forgiveness, revised pay-as-you-earn's interest subsidy may be appealing because it limits that negative amortization or that extra interest that's accruing every single month. So that's certainly a pro for revised pay-as-you-earn, but you'll want to weigh that in consideration with the lack of a monthly payment cap, the fact that it may take your whole household income into consideration, and the fact that it's a 25-year forgiveness instead of a 20-year forgiveness. So some big kind of pros and cons there to weigh through as you're comparing those three 10% plans. So let's say this individual was in repayment for 5 years with $170,000 borrowed, and that he'd chosen the revised pay-as-you-earn plan because of that interest subsidy. Since he was single, might as well choose repay. What would that look like? Well, after 5 years of repayment, regardless of the plan, he'd have paid the same amount to $24,000, but the revised pay-as-you-earn, the remaining debt, would be around $186,000 because some of that debt would have been handled with the interest subsidy under repay. Let's say at that point, the borrower decides to get married. At this point, his income would have risen from the original $60,000 adjusted gross income we estimated up to $76,500 a year based on that 4% raise over time that we discussed. And let's say his spouse had an income of $85,000 a year. What would the repayment setup look like then? At the beginning of year 6, the borrower has a few options. If they remain single, their payment would be around $460 a month based on that newer increased adjusted gross income we talked about, where we were projecting that it would rise every year. When they get married, if they marry filing their taxes jointly, their payment would be around $1,100 a month, because now we're taking into account two incomes, the $76,000 for the borrower and the $85,000 for the spouse, for a total adjusted gross income of around $161,000 a year. However, if the borrower chooses to file their taxes separately, then under the new IBR plan or pay-as-you-earn, the monthly payment would actually drop to $400 a year. Because in that situation, because of the filing separately, we would only be looking at the borrower's income, but now we would also be taking into account the fact that it's a two-person household. So remember that initial calculation we talked about many slides ago? That would come into play here. The household member headcount would cause that calculation to change. However, under revised pay-as-you-earn, even if taxes are filed separately, they're still taking into account both incomes. So you can see that would be $1,100 a month there as well. So what do the choices look like at this point? Well, the borrower could switch into pay-as-you-earn, stay in revised pay-as-you-earn, or switch to extended. Let's put some actual numbers to those and see what those choices might look like. If the borrower chose to switch to pay-as-you-earn and file taxes separately, the monthly payment, as we mentioned, would start at about $400 a month, continuing with the same estimated 4% raises over time. By the end of year 20, the payments would have risen to about $848 for a total paid from years 1 through 20 of about $133,000. Remember, that was on $150,000 borrowed, so we still haven't even gotten to the amount borrowed at this point. But what's not included in that total paid estimate are the tax consequences that will occur when, at the end of year 20, $254,000 or so worth of debt are forgiven. Remember, under pay-as-you-earn, that forgiveness is a taxable event, so that $250,000 will show up as income in that year on that borrower's tax return, and they'll pay whatever their current tax bracket is on that. So call it 25, 30, 33%. So that's something that you'd want to factor into consideration. The next plan, revised pay-as-you-earn, is what the borrower is in for the first 5 years. What would it look like if he just stayed in it through year 25? Well, he won't actually make it out to year 25 because now that he's married and we're looking at two incomes, his payment per month will start out at $1,100 a year in year 6 and jump up to about $2,200 a year in year 22, at which point he will have repaid the loans in full, paying a total from year 1 straight through year 22 of around $337,000. Extended repayment, remember, is constructed to pay the loans in full. So if he chose to switch to that in year 6, they would take a look at how much debt was left, the interest rate, and the remaining 20 years, and calculate a monthly payment of about $1,365, which would pay the loans in full through year 25. And if he took the full 25 years to repay, it would be about $350,000 total paid over time. But again, in extended repayment or really any of these plans, the borrower could choose to pay more at any time with no prepayment penalties. Let's change gears now and talk about a public service loan forgiveness option. For this example, we're keeping the amount borrowed exactly the same. So it's still $50,000 a year for 3 years, so $150,000 borrowed, around $20,000 worth of interest puts us at $170,000 or so entering repayment. You'll notice then that the standard and extended monthly payments of around $1,900 and $1,100 a month are unchanged. That's because we haven't changed the debt. What is different in this example is the adjusted gross income, which we've lowered to about $45,000 a year, and therefore the income-driven repayment plan amounts are lower as well. The initial payment right out of this calculation using a $45,000 adjusted gross income would be about $225 a month. Over time, using the same increases of around 4% every year, by year 20 it would be up to about $670. By year 25 it would be closer to $900 a month in that monthly payment. Again, over time, as income rises, those monthly payments will rise, and you can see how they would track over time. So let's say this borrower was working towards public service loan forgiveness in a qualifying job for 10 years. The amount paid over that 10-year window, regardless of the plan, would be about $36,000. You'll note that we don't have a forgiveness column on this page because it does not matter. Public service loan forgiveness is a non-taxable event, so we're not concerned with the amount remaining in debt because it's forgiven without tax. However, let's say that this particular borrower, after year 5 of qualifying public service loan forgiveness payments under an income-driven repayment plan, has their dream job fall in their lap. Would cause them to leave public service, but would have a new adjusted gross income of about $125,000 a year, so a big pay bump for something that they'd really like to do. After those 5 years of payment in one of the income-driven repayment plans, they would have paid around $15,000 total. Their remaining debt under IBR New or Pay-As-You-Earn would be about $209,000. It would be a little lower under Revised Pay-As-You-Earn, again because of that interest subsidy, so call that $190,000. Beginning with year 6 and starting with that new adjusted gross income of $125,000 a year, their monthly payments, of course, would be recalculated under Standard or Extended. Using the $190,000 from Revised Pay-As-You-Earn that we just mentioned, you can see those monthly payments would be a little bit expensive. Standard would probably be out of reach even with the new salary. Extended might be a little bit more affordable with 20 years left of the original 25 to repay. However, there's no reason why this borrower couldn't continue to stay in an income-driven repayment plan and just pay the increased amount reflected on their new higher adjusted gross income, and that new monthly payment would be around $900 a month. So then, if we look at the long-term projection for any of those income-driven repayment plans, you can see the total paid listed in each of the columns here, and then the total amount that would be forgiven after either 20 or 25 years in one of those income-driven repayment plans. So even with that increased salary, there would still be something left to forgive. And remember, though, that this person had switched out of a qualifying public service loan forgiveness job into a for-profit job with that higher income. So that amount that's forgiven after 20 or 25 years is not related to public service loan forgiveness and would be a taxable event. The main thing I hope that you take away from sitting through this session is that there are many different choices for federal student loan repayment, and that one of them will work well for you at whatever stage you're in, financially, personally, professionally. Wherever you are, one of these plans will work well, and that plan will change as you go through your life and your career. So I do continue to encourage you to use a calculator to take a look and see which of those plans will make the most sense for you right now and then down the road as well. Some examples of some situations where you would want to sit down with a calculator and crunch your numbers to figure out whether the plan that you're in is still the best one for you or whether it makes sense to switch strategically would include any major changes in your career, your position, or your salary, especially if you're changing in or out of a public service loan forgiveness qualifying job. If you come into some extra money, which we can talk a little bit more about in a minute, changes in family size or relationship status as well will certainly impact your monthly payment amounts if you're in an income-driven repayment plan, and may also impact your strategy decisions as well. Another great set of circumstances during which you can reevaluate your federal student loan repayment plan would include yearly checkpoints. So sitting down once a year to take a look at all of your finances with a partner or a spouse, if you have one, go through everything together, insurance coverages, financial goals, accounts, everything like that, and student loan repayment plans to make sure that you're on the same page and that you're still in the best plan and account that works for you. If you are in an income-driven repayment plan, you will need to renew that paperwork annually. So that's something maybe you could time your family's annual financial wellness check to be around the same time that you sit down and do that renewal paperwork. And of course, if you're working towards public service loan forgiveness, that employer certification form needs to be filled out once a year. So that's a great time to lump that in together and take care of that paperwork as well. So what happens if you're in repayment and you're having trouble making payments for some reason? Well, one of the first things you should do is to pick up the phone and call your servicer. They are there to help. They will give you your options and can talk through how those will work for you. One of the first things they may recommend is a deferment or a forbearance, which is a short-term postponement of payments. However, deferments and forbearances have a limited amount of time for which they're available over your lifetime as a federal student loan borrower, so you can use those up if you're not careful. In addition, they don't typically prevent interest accruing. They don't count towards public service loan forgiveness or any of the other forgivenesses. They're just kind of like pressing pause in repayment. So it's a good idea to have a handle on how those work and how those will impact you before choosing one of those. That said, they're often very easy to get in many cases. Sometimes they can be applied right over the phone. Sometimes you might have to do a single sheet of paper form to get those. So if you are in need, that's why they're there. If you think that your finances will be dramatically affected in a little bit of a longer term and you're not already in an income-driven repayment plan, as we saw, those monthly payments can be very low. So that can be a great way to set yourself up with a lower payment for a while until you get back on track financially. But again, do make sure that you're aware of how interest will accrue, how it's affecting public service loan forgiveness, and make sure your plans are taking those strategic markers into account. I mentioned before windfalls and what happens if you come into some extra money. Well, financially, there are some strategic things you can do with that. One of the first things that any financial planner would recommend that you do, and we would recommend as well, is to take a look at your emergency fund and make sure that you have generally 3 to 6 months worth of expenses set aside. After that, you can look at targeting debt that you might have. So many people would look at paying down student loans, credit card debt, maybe a mortgage, that kind of thing. Something you can consider doing is taking a look at the interest rate on your debt and targeting the highest interest rate debt first. For many people, that would be credit card debt, followed by student loans, followed by mortgages. So you can take a look at handling it that way. Something else that you'll certainly want to do is to start to plan ahead for retirement, even if it's very far away for you. It, among other things, it comes up faster than you might expect. No one will ever lend to you for retirement, so it's a great idea to make sure that you're putting money away for that as soon as possible. And of course, the sooner you start, the more time you have on your side to take advantage of the power of compound interest. So it's always a great idea to start planning for retirement sooner than later. And then, of course, if you have children, saving some money for their college funds is a great way to plan ahead as well. We touched on this earlier, but just to delve into a little more detail, there are no prepayment penalties on any of the federal student loan repayment plans, so you can pay more than what's due every month at any time. However, the biggest single complaint to the Consumer Finance Protection Bureau on federal student loan repayment is the misapplication of prepayments. So please do be very careful with these and know that it's challenging for the servicers to apply these without you giving them express information and details on exactly how you want these monthly payments or these extra payments applied. So before you make a prepayment for the first time, reach out to your servicer, ask them the best way to communicate with them, when you should send that in, how you should send that in, and make sure that it's being applied as you'd like it to. For example, as a payment towards the principal of your highest interest rate loan. They may tell you to write that down as loan 4 or group G or whatever their exact language is. Try to mirror that, whether you're making the payment online or by check, and then double check and make sure that it's being applied as you've requested. Consolidation and refinancing are hot topics in federal student loan repayment. They both refer to taking out a new loan that's used immediately to pay off your existing federal student loans. Consolidation is the term that's used by the federal student loan programs, so you can take out a new federal loan to pay off your existing federal loans. You may have some folks who encourage you to look into that. It's certainly something that you can do, but for most students, there's not really a benefit to doing a federal consolidation these days as much. The federal consolidation was very beneficial back in the days when interest rates were variable on federal student loans, which they really aren't anymore. It was beneficial back in the day when students had lots of different federal student loan servicers, which is no longer the case for almost everyone. So there really aren't a lot of pros to it. The only time federal student loan consolidation definitely makes a lot of sense is if you have older pre-2010 FFEL loans or FEL loans and you're looking to get into public service loan forgiveness. That would be a time when Consolidation would turn those older FFEL loans into direct loans, which would become eligible for public service loan forgiveness. Refinancing is often the term used by private companies who are issuing you a private loan to pay off those existing federal student loans. The pros to those are that the interest rates can sometimes be quite a bit lower, especially if you go with a variable rate. The cons are that most of the private refinancing options do not offer the flexibility and certainly the forgiveness terms of the federal student loan programs. So please do your research, make sure you understand what the program is like that you're getting into. Certainly if you're going for public service loan forgiveness, you want to avoid a private refinancing, but even if you're not, be sure you understand the forgivenesses for things like death and disability before you exit the federal student loan program. Some strategic thoughts for you as you begin to make your personal decision on your federal student loan repayment plan. Don't forget that federal tax returns do allow, in many cases, some deduction for student loan interest, so keep an eye out for that. You can choose to set up your monthly payments through your servicer automatically, and often that will give you an interest rate reduction of something like 1/4 percentage point. It's not a ton of money, but every little bit helps. In many cases, you'll have the opportunity to pay down or even pay off some of the interest that's accrued before that interest capitalizes at the end of your grace period or during any other period of deferment or forbearance, or an income-driven repayment period coming to an end. You can choose to make those payments to lower your overall costs. That can be a great idea if you're able to do so and if your eventual goal is paying your loans in full. And then finally, when you come across any windfalls, if you're able to do so financially, you can use those windfalls to round up your monthly payments, maybe adding an extra $100 every month or more, or just send them in as a lump sum in order to speed up your payoff, lowering your total overall interest paid. A calculator will be a very beneficial tool for you as you go through this process. It will help you crunch your numbers and determine what your monthly payment options look like. Not just now as you're getting ready to graduate and choose a plan, but down the road as well as you're going through life checkpoints where things may be changing. It's a great tool to reevaluate the options that are available to you and make sure that you're still in the plan that makes the best sense for you financially. We offer a free phone number, web chat, email, loan communication service where you can reach out to us with any questions you have on federal student loans, particularly loan repayment. That service is called Access Connects, and their phone number is here on the screen. Please let us know if there's anything we can do to help, any questions we can answer. The folks who answer the phone are very thorough and helpful, but if you do need more of a one-on-one counseling session, they will pick a time for you, and one of our accredited financial counselors will call you back at the day and time that you select. Thank you for joining us today, and congratulations as you embark on the road to zero.